data yet. So there will be a lot more bad news, but markets are always forward looking. So if economy weakens, that doesn't necessarily mean the market will crash hard. And so that's what we're trying to understand, where Bitcoin sits in all this chaos. And Wizard's focus on on-chain data is very, very helpful here to help us, have an X-ray vision into what's happening in Bitcoin. And we layer on top of this macroeconomics and macro events to give a full picture. All right, so let's see. Maybe I'll take a quick look at our quantile model. Let's see if this, yeah. So this is a chart that you guys probably have seen many times, trying to value Bitcoin along its trend. I've made some improvements to the looks. If you don't see any difference, it has taken 6 hours for these little changes. So basically, this is showing that our risk score is 57% at the price of $95,000, essentially showing that if you look at the full distribution of prices here, we are 57% along the way towards the top. And do we have a closer one? Yes. If you zoom in, this is where we are in the green zone. And that's kind of like same valuation as we had, say, for example, in 2021 or late 2020, valuation-wise, that's the same. What happens next is unknown, probably driven by macro events, right? So whether we will exactly follow last cycle or not, it will all depend on what happens with macro, which is what we will discuss as well. And but overall, for a long-term investment, this is still a really good risk reward for a long-term investor. But over the short term, there's a lot of volatility that's still coming because as the market reacts to all that negative news. So let me see if I can also share our report. I thought I had shared it, but okay, this should work. All right, so this is our write-up Bitcoin intelligence report. If you are not looking at this, definitely check it out. This is where to go, 21stcapital.com/BI. And then you'll find the link to our platform, Bitcoin Intelligence, which has some charts, some of my models, the quantile model that we just saw here, and then our writings. So the last piece is looking at, again, like many of the previous pieces, looking at a combination of macro and on-chain data. So first, we begin discussing macro developments. And we warn about what's going to come, the flow of negative news that's coming. Today, again, we got a glimpse of it. And if I can, yes, so that's our GDP numbers that came out. Q1 GDP was negative 2025, but a lot of that is because of the imports. And the effect of imports. When companies front ran the tariffs, they imported too much, even though it shows up as negative number here. That's because there was too much import, and imports negatively go into the formula for GDP. So it makes GDP look a lot worse than it is actually. Nevertheless, tariffs are supposed to slow the economy. I mean, that's an expected effect. And we still haven't really seen the real impact. Some other things that we expect to happen, I think if we go to our previous reports, we will see, where do I have? Yes, we will see some of the expectations we've had in the past was that as recession shocks ramp up, we should also see disinflation. And then today we see the PCE price, PCE inflation goes down. Core PCE goes down, which is the main metric that the Fed looks at. And again, for that, the reason for that is as recession fears ramp up, people just will pull back on spending and purchasing, and all of those things will put downward pressure on prices, no matter how much extra you pay for tariffs. So once that happens, you will get negative economic news. You will also get disinflation. Inflation goes away. GDP slows. Then the conditions for Fed rate cuts are met. It's not likely to happen in May. So this coming event of the Fed FOMC is probably not going to include a rate cut, but the next one is pretty likely. So after May, in June, we should start getting all those rate cuts, and then negative effect of the tariffs will also be slowly priced in. And then towards the second half of the year, we should get a lot better news, a lot of positive behavior in the market. So that's about that. And then hopefully once you read it, you feel a little bit better about and definitely not panic about all the damage that you will see in the social media. The other thing we mentioned is that Bitcoin is really doing great in this environment. It's doing fantastic, especially if you look at NASDAQ. It has been, first of all, when the markets crashed, Bitcoin and NASDAQ went down together. And if you've been following the market for some time, you know that Bitcoin is really expected and used to crash a lot heavier, a lot harder than NASDAQ. But it's only doing a one-to-one crash together with NASDAQ. So it looks like on the downside, it doesn't look riskier. But on the upside, as NASDAQ began recovering a little bit, Bitcoin rapidly recovered and almost closed the gap. So the Bitcoin NASDAQ ratio is almost back to where it was and has recovered all the damage. So it seems like Bitcoin, what it's doing is it is getting less hurt by the sell-off in the US assets, but it's getting more support as markets recover. And for that, again, in our piece, we explain some of the logic behind this. The idea is that most of the tariff-related sell-off is a loss of confidence in U.S. economy. And especially when global investors pull the money out and move to other assets, maybe local assets. I've heard a lot of Canadians, for example, repatriating their investment. Maybe Wizard can shed some more light on that, but then they will invest in local companies. And same thing happens in Europe, other places. So money is losing confidence in the US, but it's not losing confidence in Bitcoin because it's a global capital. So some of that money that is taken out actually ultimately ends up finding its way to Bitcoin and gold. And that's why these things are also going up. Yep. So that's another positive event. Looks like in this environment, actually, Bitcoin is becoming more of, like, instead of a pure risk asset, it's becoming more of a combo of risk and safety. The safety part comes from the idea that if, say, China and US don't like each other and they want to start a capital war, they will hurt each other's economy. But in fact, some of the capital that's repatriated goes into Bitcoin. So Bitcoin actually becomes the more preferred asset in that environment. So that's a very interesting trend to watch. Gold is definitely doing that. So it got a huge beat during this whole chaos. It's near all-time highs. It has come off a little bit because geopolitical fears have gone down. And when that happens, actually Bitcoin catches up and surpasses gold. Okay, moving on. Just one final discussion about whether recession is coming. You could read this. Our idea is, as we've always said, tariffs are very, very hurtful for the economy. They are recessionary. They are a friction. When you do trade, and you added friction in that trade, you slow down economy, right? So people say, oh, there is revenue generated for the government, and that revenue could be given to companies, but the total revenue that's generated doesn't cover the reduction in economic activity. So overall net, it's a loss for both sides, right? However, the other part of our thesis is you shouldn't also imagine a full disaster, because we explain our logic here. I'll be very quick. Again, you can read the full report, but one of them is this is a problem caused by one man. Okay, maybe a couple of advisors behind him, but essentially one man. And that one man can't afford, politically, he can't afford a recession. And he can stop it. The moment he lifts tariffs and says, okay, guys, we have to exempt many products. Maybe we'll keep some tariffs here and there, a little bit on China and some other rogue actors here and there, but most important products will be exempted. The moment he does it, we are back to the same level and beyond, right? So he can fix it, and he can't afford a recession. So the moment we begin to actually have recessionary data points, I think he will pivot. And we've already seen many examples that he pivoted, right? The 90-day pause after the bond sell-off, and the other points that we are listing here are showing many examples where, and exemption of electronics from China. We will see more of this because they are not really making great progress on the deals. And they're getting a little bit desperate, like announcing deals are coming. Nothing is really happening. Like the other side doesn't confirm. So they're getting desperate, and I think over time they will see that deals are happening at a slower pace than tariffs are damaging the economy. So they have to back down a little bit. The only question is how can they do this politically nicely, right? So it doesn't look like a loss. So tariffs are recessionary, but a full recession is unlikely. That's it, in our opinion, right? We might get a shallow recession or something that's not terrible. That's not a disaster for the stock market and for Bitcoin. But essentially, we're saying don't panic too much. This bad news is bad, right? But not too bad, especially if it gets to a point where job market is hurt. Then the Fed will come in and begin pumping the markets, and before everything pumps, Bitcoin will react to it, right? So it's not as bad as you might hear in the media. Then the second part of the report moves on to on-chain, deep on-chain analysis from one of the best on-chain analysts, Wizard. So I'll stop and I'll let you take the helm.
Sure.
Do you want to share your own charts from?
Yes, please. Yeah. If you don't mind, because I have some live version of those charts. I would like to show them.
All right.
Okay. How's my volume? Is it high enough? Sometimes I cannot hear myself. Is it loud enough?
My speaker is probably not loud enough, but let's see.
Yeah.
Yes, pretty good.
Okay. So, like Sina said, I was in Bedford. I was in Cheat Code. It was a great conference. Whoever was there, I miss every one of you, and whoever was not there, I very encourage everyone to be there next year. It was great, lots of Bitcoiner, and that was why I was not actually doing video with Sina. I do apologize, but I had fun, a lot of fun, and I hope you just forgive me by being absent for 2 or 3 weeks. But 2 weeks ago, we put out a piece on Glassnode, inside the Glassnode.com. I'm going to just go over that, and then I'm going to come back to the Bitcoin intelligence report and then tie it together. But the main message I tried to pass to the audiences and readers is this rally was pretty constructive. You could see the spot market was backing this rally. It was obvious, especially the ETFs were showing a strong inflow. I think it was one of the top 10-day inflow actually to IBIT. So we cannot deny that the spot market was seeing this rally I'm backing this rally as a chance to, hey, we might go see an all-time high. Because no one knows when we're gonna actually bounce back and go to a new all-time high. That's the reality. That's the fact. But we have to use the data and see how strong is the spot weight in the rally, or how possible it is the people who are in loss start to spend their coins, or are we close to the point that people that are on break-even point might be incentivized to sell? So these are the questions we want to answer. And I try to start with the week on chain, or the report we put on Glassnode, and then come back to the Bitcoin intelligence. In that report, I started with a very, very interesting chart that me and Sina used it almost in every episode that we talked about Bitcoin. And this is a short-term holder. I try to use the term recent investor instead of saying short-term holder, because it might be a little bit technical for our audiences. But literally, the investors who bought in last 6 months, active investor, recent investor, or I can even say it is closer to the demand side in the market, the investor that are representing the demand side. The blue line is showing the cost basis of this investor. And like we explained before, the bull market and bear market can be, I mean, when we look back on the data, you could see the bear market and bull market can be categorized or highlighted by this metric. When price is trading above this line, the trend is positive. The momentum is strong because the price is trading above the cost basis of the recent investors, and you can say these investors are incentivized to invest longer and stay in the market. They see, hey, I'm buying and today and 20% in 1 month. It's bringing confidence into the market. The other side of the coin is when the price drop below their cost basis, which is the blue line, is when the momentum is dropping. The new investors are entering into the market, but the price is keep trading below their cost basis, and that causes and damages the new investors' confidence in the trend. So this is a very strong metric that gives us a compass to see if we are in the bull market or in a bear market. And you can say, yes, sometimes in the bull market we might break below this cost basis temporarily, but we are seeing the price coming back above very fast, or we can just stay agnostic and say, hey, we don't know when it's going to come back, but when it comes back above this cost basis, this is a bull market. That's the better framework that I always stick to. But when we look back in February, when price broke below 92,000, which was at the time the cost basis of these new investors, we could see, hey, the demand is diminishing. The market is showing some weakness. And the yellow line and red line here is the standard deviation bands over this deviation from the cost basis, meaning if you look at the price deviation from the blue line, which is the cost basis of the new investors, and try to statistically see when is extremely risky or when is low risk, we can use the one standard deviation plus and minus. And for example, when we are one standard deviation away from the cost basis of new investors, we can say, it can be translated that these new investors are statistically in a point that they feel, oh, we have a lot of profit, it's time to spend, it's time to get out of the market. And the other side of the story is when we get to the one standard deviation below the cost basis, that is the point that they are exhausted. The majority of them are flushed out of the market. They are in extreme loss, and there's seller exhaustion situation happens in the market. If you go back and look at the when price broke below 92 and it went all the way to 72 and 71,000, you could see we were very close to it broke to 74, 76,000. It was very close to the one standard deviation low band, which was around 72. So you could say at this point, the recent investors, which happened to be the all-time high or top buyers, they were at extreme loss point. And one could say, hey, this is the point that the seller exhaustion might happen and we should expect some bounce back. If you want to go a little bit closer, I can show another chart that exactly shows what happened in that moment. This is another chart that is very strong. It shows the darker the color is, that means more coin has been bought in that price. And lighter it is, that means less coin, circulating coin has been bought in that price, or still is being kept in that price. Let's say I buy a coin at 73,000. This bar is going to get darker. And if I start to spend, this bar is going to get lighter and lighter. If you go back and use the 2024 Q3, Q4 As an example, you could see when market hit to 70. I don't know what was. It was a new all-time high, and then market started to enter a weak phase. You could see we had a couple of these bounce backs, but every time we were bouncing back, you could see people were buying close to the top. It's like some sort of like FOMO. Oh, this time we're gonna break. You could see they were buying again. Let me just zoom in a little bit more. Every time, just we were rallying, people were buying again and again. But at very last bounce back, before we see a sharp spark in the market, during the rally, you could see all prices had a strong buyer stepping into the market. It was a very strong spot market effect on the impact on the market, and that last jump that we saw in October before the election, probably because people were saying, "Hey, Trump is going to be pro crypto." It could be macro. A lot of factors might have led into this behavior, but from on-chain data perspective, you could see the last spike was backed by very strong buy pressure in the spot market. Now, if you zoom in at the recent event last 3 months, let me change this to hourly. If you look at the hourly version of this chart on a 3-month window, you could see at 93 to 96 after market. Let me make it 6 months. Actually, it's easier to. Let's go all the way back when we had an all-time high. Then market crashed to almost 95, 90, and then people were buying the dip. They thought, hey, we might be just go through a temporary correction. We're going to go back. Every time market was crashing, you could see some buy pressure in the market. Then we went to 105. Then we crashed again. We saw a very strong buy pressure around 93, 96. That was in a strong accumulation. One could say, hey, we are seeing a strong buy the deep behavior in the market. We might just actually go above 1010. But the macro was mess. I think it was the beginning of the 90 days, announcing they're going to be in 90 days. In 90 days, they were expecting a tariff on China and everything. The macro was turning really, really south, and then market started to crash. And when we crashed below 93, every time we were just getting below 80, you didn't see that much buy the dip behavior. See, it just the colors stayed cool. That means we didn't see enough buy pressure. We saw a little bit bounce back because we were getting close to the cost basis, the standard deviation below the cost basis of all these top buyers. But at very last bounce back around 83 to 85, you could see, yes, we had some people buying into the rally. And this was getting warmer and warmer all the way to 90 to 94. And now, after we broke above 90, we're seeing some sort of FOMO. They're buying, instead of buying all the way through the rally, they're now buying close to the top. Many might say, hey, this is a positive thing because they're buying, and the buy pressure in the spot market is aggressive. And as I'm going to show in a minute, yes, the spot market has started to get even more aggressive when we got above 90, especially in the ETFs. But there is another counter argument and saying, hey, this is a top buying FOMO kind of behavior, especially after seeing a lot of coins spent after we just failed to break above 1010. Look, all these coins are, you see these lines are getting a little bit cooler and cooler. People are spending, but that 94 buying above 90, that could be actually a top buying or FOMO into the market. But no matter what,
I also spot a pattern. Like in the first crash in February, right? That's pretty late February, right? This is when, like macro-wise, this is when people started to realize that tariffs are actually happening, right? So Trump really doubled down, and it felt like it's becoming a reality. So then the illusion, people were disillusioned, and we realized, oh, this is going to happen. So market began selling off. Now, it was a pretty terrible sell-off, right? Fast all the way down to 80, low 80s, right? But looking at the buy pressure, we did have a bounce back up, but it was on very low volume, low buy pressure. So seems like it bounced back up on weak support. But as time goes on, you see the strengthening of the buys, the dip buyers, right? I think if you're analyzing a crash, this would be a very interesting pattern to watch. Like early in the crash, you maybe you don't want to buy the dip that too early, right? because
Yeah.
it's going to be very messy. And but over time, as you observe in the data that new buyers are showing up and dips are being more heavily bought, that probably shows that a stronger rebound is coming.
Exactly. Like confidence takes time to be rebuilt. That's literally something that is so obvious that people just intuitively think about it, but using this chart, you can exactly say what you said. And over time, you'll see the deep buyers are getting more confident, and every time price see a correction or crash, these bars getting warmer and warmer. That means the deep buyer at the beginning, like you said, is just very not confident in the market. And the reason price bounce backs is literally there's no seller exhaustion. Whoever were about to sell, they sold, and whoever is gonna hold is huddling. And over time, that confidence in being rebuilt, and we saw that relief rally. But like I said, we cannot say for sure because, as you explained earlier in this video, in this episode, that macro is very effective in this moment. Bitcoin is seeing a lot of correlation between the price ticker Bitcoin market and a lot of risk on assets in the macro economy. And I expect actually this sideway go on until we see some clarity in macro. But what I was trying to say, that bounce back was mostly, especially at the beginning, was because we're getting close to the extreme pain point for the new investor. And when we got really rally back to 92 or above their cost basis, it was mostly because at very last dip we saw a strong buy pressure in the spot market. One might ask why we are focusing on the recent investors, why we're not looking at the long-term investors. This is a very great chart that I can use to answer that question. This chart is showing the supply, and they're putting the supply in different buckets based on their
Any
cost
chance you can
basis.
any chance you can make it larger, because it's fine,
This
but
one,
yeah, but
sure.
yeah,
Let me make it even larger.
yeah. Uh, too much of the headers.
Yeah. Let me just make it one. Okay. Yeah, I hope it's just good enough.
Yep. All right.
Yeah. So this chart is categorizing the supply by every coin by the cost basis of that coin. For example, if you see there is 200 or 300,000, 210,000 at the cost basis of 20,000, that means there are almost 200,000 of coins being moved or purchased at 20,000 and still not being moved. So the blue lines are showing the long-term holder. That means the coin, the long-term holder's asset or supply means whatever is being categorized at these bars have been purchased 6 months or before 6 months ago. But whatever is actually in red is showing the supply that have been purchased or moved in last 155 days. And as you can see, price is hovering in the region that majority of coins at loss are the short-term holders. So that's why, especially when we are post all-time high, when we are in a decisive moment that we might enter in a long bear market, or we might see a bounce back or a strong recovery, when we are in that decisive moments, when the trend is not obvious, we have to look at the short-term holder or recent buyers, because their behavior is going to determine the next mid to long-term trend in the market, upcoming trend in the market. So when we look at them, yes, we saw a little bit seller exhaustion around 74 to 76, and then we saw a little bit buy pressure after we hit to 72 or sub 80 at second time, and that rally was really strong in spot market. But I call it a fragile rally. Why? Because we have to stabilize longer than 1 or 2 days above the cost basis of short-term holders before we calling for a, hey, bull market is back, we're going to go to a new all-time high. To support that hypothesis or theory, I have to use another chart. This is a very, very nice chart. This chart is looking at the supply of the short-term holder, like I explained why short-term holders are important, because they're determining the mid-term to long-term behavior in the market when we are at a pivot point, close to pivot point. This metric is showing the ratio between number of coins in profit to the number of coins in loss, only for the recent buyers. For example, if you see this metric is at 1, that means the ratio is at 1, 50-50. 50% of the supply is in profit, 50% is at loss.
I
When
can't
you
see
break
the
above,
title. What is it called? Is it NUPO
oh,
or
no,
what
it's
is
the
it?
short-term holder supply
Okay.
profit loss ratio. So it's looking at the ratio between the coins owned by the recent buyers, and then look at the coins in profit, measure that number of coins that are profit to the number of coins in loss. Okay, so when we are at extreme number, and it's in log, scale, when we see extreme positive, we see the extreme positive, it means more than 90%. Like this is the line that you can say is 19. The green line ends at 19. That means 95% of coins are a profit. When we go to the gold area on top here, that means plus 95% of the supply owned by the recent buyers at a profit. When we break below 1, that means more than 50% of coins are in loss. When we are at 0.1, that means more than 90% of coins are in loss. So these are when we break beyond the green and red lines, that means an extreme profit and loss. What you could see in the bull market, we are usually trading above y equal to 1. I mean, most of the time, majority of supply plus 50% of the supply owned by the recent buyers in a profit. But in the bear market, we are bouncing between extreme number close to 0 all the way to 1. So that means the majority of the time, most of the supply owned by the recent buyers in loss. That's a feature of the bear market. As you could see, we had a bear market in 2024, and after breaking below, I think 96, 93, we saw the majority of the coins owned by the recent buyer were in loss. Obviously, these are the buyers who bought after the election all the way to 108, 105. As soon as we broke below 96, the majority of them were in loss. Now, throughout the rally back to 93, this metric saw a bounce back to 1. In bear market, we saw that. And in the middle of the bull market, we saw that as well. Like back in 2021, when we had the China ban and the China ban uncertainty was over, and we saw a strong bounce back. What we saw in this cycle, see one episode all the way to August 2023, we were bouncing above 1. Then after August 2023, we saw a little bit bear market. And then we had all the way up to June 2024, then the bear market. After October, after the election was actually getting closer, we saw a bull market all the way to 105 and then bear market. The beauty of this chart, I mean, a lot of people talk about the 4 cycle is gone, and I actually am in that camp. That being said, having 2 all-time high, especially the 108, 110, some might say, hey, this is a very short time to rebuild that lack of confidence. That's what I believe. But hey, Bitcoin is always going to surprise everyone. So when I was writing this piece, I was expecting, hey, we're going to see a relief rally all the way to the equilibrium where 50% of the supply owned by the new investor are in profit. And then we're going to see a sell pressure from both short-term holder who bought at the bottom because they bought at 70 something. They see a little bit profit. As I'm going to show later, some of the sell pressure at the 93 was the people who bought at the bottom. And also, it's going to be a little bit sell pressure from people who were at loss all the time that we were below 93. Now they see the price is getting close to their cost basis. They might start to sell at break even because they were like suffering by being in loss in last 2 months. So that's why we are in a decisive moment. If we want to see a bull market, if you look at every single sustainable bull market plus 1 month cycle bull markets, you have to go back and see. We have to see this metric comes all the way back to 19 or 20, which means more than 95% of the supply owned by the recent buyers be in profit. But when we go back to that heat map, that means we should be above 98. So if we go and stabilize above 98, that means the majority, more than 95% of the recent buyers are in profit. That means confidence. That means the recent rally was not just a dead cat bounce, and the confidence in the market has been revived enough that the momentum will push the price even higher. But until then, until breaking above this big supply, this is a very huge amount of supply here, that the might start to sell at break even. Until then, I will look at every bounce back, something like what we saw between December 2021 all the way to January 2023. These are all relief rallies or dead cat bounce, or whatever they're gonna call it. But it is a reversion to the mean value, to the point that market is in equilibrium. And to prove my point about like the short-term holder were the main sellers, like I said, when we're getting close to the Chi spaces, if you look at another metric, which is SOPAR.
Can you go back to before moving on?
Sure.
Yeah. So I want to point out, yeah. So basically, in the bear market, dead cat bounces, we became, particularly in the last cycle, we became really, really sold off. Like we went down to the gold region, and then we bounced with a little bit of price recovery. Everything went back to green, and then we go back to red and gold, and then we have a little bit of recovery, and then we go back to green, and then the price still crashes. So how do we know that the move to green is this time is not like the other times? So one of the things you mentioned is if it's significant enough that it then restarts the momentum and FOMO trade. But what metrics will you use to determine the end of or maybe reject the dead cat bounce? I know you commented on this a little bit, but it's very interesting distinction, right? It's a huge difference between getting it fully right or fully wrong.
Yeah. I mean, we have to use other metrics, but if you want to use just this metric, is sustaining that green phase. Just a small bounce back to the green one is not meaning that bull market is back. If you notice, like just look at 1 month, at least 1 month above the staying in the green is needed. Look at every single time we stayed here 1 month in green. Then look, we had a bull market for 3 or 4 months. Okay, then here we had a bounce.
I think the rule exactly. So I think the rule we can extract from what you said is that coming back to the green region restarts the sell-off for people who, like you said, the suffering ended. You're back to break even. You want to get out, right? If that is strong enough, we go back to negative, and that's a sign that hey, this was not sustainable. But if the sell pressure is not enough and we keep going up further, that means this has legs.
Yeah, but I'll use other metrics because we have plenty of metrics, especially the derivative market and the spot market. There are lots of other metrics that we have to, when we are back at the break-even point, we have to use them. It is very naive to only use this one. But if you're forcing yourself to use this one, you should sustainably stay above 1 for at least 1 month to say, hey, more than a month that the recent investors are being in profit. So that means the confidence is back into the market. But I'm going to actually answer that question because I had the same question. Hey, is it the bounce back? How are you going to just explain this? The other thing that I use are going to be the next chart. The next chart is, let me see. Yes. Yeah. I'm going to go to the perpetual market when I see, hey, we are at the decisive moment. Is demand back? Is market warming up? The first thing I use is the funding rate, and we use it a lot, and we explain it to our audiences. Let me just use, this is an average funding rate. Let me do like a 7-day moving average. As you can see, after breaking to 108 back in December 2024, since then the funding rate is dropping. And I explained before, the 0.1% is a threshold between the high demand or market's positive momentum, and below 0.1% is literally the demand is weak. The demand is not strong enough. And actually, the perpetual market is a canary in the tunnel. Is the early sign of seeing market is seeing enough momentum to expect another bull market, at least the midterm bull market. And as you can see, it turned out negative when market was rallying. I'm going to explain what is my read. But the bottom line is we have not seen, especially the 7-day moving average. So we are just canceling the noise, looking at the trend. The trend in the funding rate is not showing any strong bounce back. If we see while prices above 90, if we see the funding rate coming back above 0.1% and prices still trading above 93, above the cost basis of the short-term holder, for me, this is a very strong confluence that I'm going to say, hey, a midterm bull market is very well expected, unless something like drastic happens in macro scale. But this actually turned negative while market was rallying. If you look at another metric, which is a derivative derived from this one, this metric is looking at the funding rate multiple the open interest. Like we are using the funding rate, average funding rate, total perpetual. Let's see, it's loading. It takes a little bit of time. Funding rate multiplied by open interest. Why would we do that? If you're calculating the dollar value paid by the long side of the perpetual contracts and see how much per hour they're paying to keep their long position open. When this metric is very high, it is giving us, it can be translated to the fact that they are confident in the bull market enough to pay, I don't know, up to 2 million per hour to keep their long position open. When this metric is dropping in, like bear market in 2021 or the bear market in 2024, it's getting close to zero or even become negative, that is a sign that the long side in the perpetual market is not confident enough, or they don't have no appetite to pay the premium and stay long in the market. As you can see, this is dropping. Even though market was rallying back, this is dropping. It's telling us, hey, the spot market shows some confidence in the market. We saw a bounce back by the deep around 85,000, a little bit FOMO above 90, but the perpetual market have not seen enough demand coming back to have a confluence with the spot market, and both of them confirm the hypothesis that they're gonna be a bull market in a near term. That is what is scaring me. And when you look at the funding rate individually at every single it was actually in the report. Like we explained in the report, when you look at the individual exchanges, especially the major one, Binance, Bybit, OKX, majority of them did not see that bounce back that you see back in 2024 before the rally, or back in November 2023 breaking above 0.1%. You could see the 7-day moving average was skyrocketing. Right now, even though the price was going back, we didn't see a strong spike in the perpetual. So when we put both perpetual and spot market together, we could see this rally was spot driven mostly, but it didn't ignite or incentivize the perpetual market, which is a very strong proxy to the traders or active investors. If you don't see them coming back to the market, it's going to be a very fragile rally. That's why we called it, and I think we call it together, the fragile rally in the market. We want to see the perpetual, or if you want to be smarter, we want to see the long side premium per hour is bouncing back to a number like 1 million. Back in December 2024, plus $1 million per hour was paid by the long side of the perpetual contracts to keep their contract open. That means pure euphoria, pure momentum in the perpetual market. But right now, we're still seeing it's going down, even though price going down. But one might ask, hey, what was the perpetual traders going? Why we didn't see like price going up and OI went up, but still funding rate is negative? That means, yes, the buyers in the perpetual market stepped in parallel with the spot market, but the people who were shorting were more aggressive. They were like more aggressive in terms of like trying to speculate the price, and they might get squeezed out of the market, but that shows the lack of confidence. When we want to call for a bull market, we should expect the very clear message or signal from the perpetual, and that's a positive funding rate, especially the 7-day moving average above the threshold value, which is 0.1%. To build on the spot market effect on this rally, I have to point out the ETFs. ETFs, after 1 month or I think it was 1.5 months of negative or close to zero inflow, they experienced a very, very strong inflow after we broke above 93, which is it's funny because all the way from 74, we saw a sell-off around 74, 76, all the way to 93, they were staying quiet. And after breaking above 90 something, 91, 92, you saw a strong inflow, which is like a FOMO to me. And so-called smart money or I mean institutional investors are behaving as a retail investor, which is really interesting. So people are saying the smart money are gonna only buy the dip. Not really. When you look at this data, you could see they bought after we break in 93, so they might as well sell when market heads south. So I really want people to just use the ETF data with a little bit cautious, because sometimes we see a lot of buy pressure from ETFs and the price is staying remaining in a sideways phase, and you see price even go down. So they are like retail investor who use the traditional vehicles to buy the Bitcoin. So they might sell, they might panic, and the recent buy was all above 91. Even though it's really positive in long term, seeing Bitcoin being bought by the institutional or TradFi, while the macro is mess, it is very positive long term. But we should not use it to speculate about the weekly or monthly price action. That's my message. At very last, I want to show another amazing chart, because a lot of people were showing the Ethereum ETFs were experiencing inflow as well. I mean, after 1 or 2 months. But why we didn't see that strong rally that we saw in Bitcoin for Ethereum? That is a fair question. So the way I try to answer it is, in order to size up the effect of the ETFs on a market, for example, for Bitcoin, you have to normalize that inflow by something that is close to a spot market. Meaning, like in this example, we normalize the inflow or net flow to ETFs by a spot volume. See what percentage of spot volume, the inflow or net flow to the ETFs is equal to what percentage of the spot volume. The larger this ratio is, that means more impactful that ETF is going to be on the corresponding asset. When you look at the BTC, after August, April 20, the 21st or 20th of April, you could see up to 10% of the spot volume was the volume of the net flow to ETFs. Is very significant. Is as significant as the market rally post-election. So 10%, equal to 10% of spot volume in Bitcoin was going to the ETFs. That means pure buy pressure by ETFs. But when we do the same thing for Ethereum, it was around 2% or 1.5%. That means, yes, we saw inflow to ETH ETFs, but it was not as impactful as Bitcoin when we look at the size of the market. So that's why we didn't see that strong momentum. Even though if it's a relief rally, we didn't see the same size of relief rally in Ethereum, because you could see obviously the appetite to risk their dollar on Ethereum is very, very smaller than Bitcoin when you look at the ETF markets, which is a proxy to the TradFi. And it's really astonishing like that. If Bitcoin is outperforming very, very very, very more significant than Ethereum, given that the both of them are having a huge achievement after having their ETFs. Yeah. So fantastic. I think we have one more chart I think we discussed, and that was this spot market volume. Like I was saying, looking at just buying the deep moment in the market, just seeing a little bit FOMO is not going to be enough to call for a bull market. The other thing I would look is the average monthly or weekly volume in the spot market. In bull markets, not only the price goes up, not only you see that the every dip being bought, you have to see the total volume, the active volume on the centralized exchanges, or if you're looking at the ETF volumes, both should go up as well. So the recent rally to 93, we could see a little bit bounce back in the spot market volume as well, but it's still, the trend is not there. All these metrics should show a trend over a month before we're calling a long-term bull market. And we are happy to see it, but so far, we have not seen all those required minimum condition before calling a bull market calling for a bull market. So far, I read this as a bounce back to the mean value in the market, which is cost basis of the new investors. I'll be happy to see a 1 month stabilization above the cost basis, but before then, to me, it's just going to be a sideway, or even if you see a negative structure in the macro economy, you might even see another sell-off.
Yeah, fantastic. It's amazing how all the signals kind of align with each other. What we actually write in our write about macro is that there's a lot of uncertainty, and there's fears are rising, and you actually can see the same dynamic play in the on-chain data as well. So let me just look at if I can figure out this complex process of sharing screen. Yeah. Then I can just look at the conclusion and wrap up today's session. Okay.
You're getting old, Sina. You're getting slow.
Yeah, technology is now over my head. Okay, so the macro backdrop is volatile and fears are rising, especially from tariffs. So over the short run, capital is also rotating out of the United States equities. We have done quite a bit of damage to the confidence in the U.S. market so far. But again, you also don't want to overstate this, because I also see a lot of politically driven commentary. So you have to be careful with that. Political bias is always bad for your investment too. So we are seeing all these negative things happening. So this should cause, again, in our macro thesis, this should cause some weakness, but not a disaster. So perhaps some chop or some slow bleed. We are not ready for a major breakout and up yet. And this is very much in alignment with Wizard was saying from his fantastic analysis and all the charts he was showing, that again, all the signs point towards some relief from the crash, not enough energy for an explosion of price. So when you consider that, the short-term scenario is probably more volatility. And I personally don't also see a significant crash. So it might be a slow bleed like we had last year. But over time, we also use our macro framework to predict that as tariffs keep damaging the economy, at some point there will be some pivot, some strong pivot that will give the markets relief. And also you have to give the bad news time to go through the cycle, to finish its cycle. And all of this essentially puts us to maybe a very confident recovery after summer, or maybe towards the end of summer. But for the next couple of months, it's going to be a little bit wash, up and down maybe. We actually, before this call, we had a client call that where a client was looking at investing in Bitcoin and getting some advice on the timing and how to do dollar cost averaging and this and that. That was my message to them as well. If we were back at like 75 or 80, this would have been a no-brainer. But right now we're kind of back. Even the Quantile model and Power Law models show we are back at the fair value. So we're sort of in the middle right now, and there isn't an urgency that some factor will suddenly cause the price to go back to all-time high. And it's probably not something that we should look for in the short term, but over several months into the future, we should see all this negative headwinds pass through the economy. So, ships are sailing empty from China. In a couple of weeks, you should begin seeing shortages at retailers. When shortages happen, you should see consumers panicking. You should see spending drop. You should see companies beginning to think about, hey, we can't really pass on these prices to customers. So how else can I save money? By reducing the headcount, starting with hiring freeze, and then reducing the time, reducing the weekly hours that employees work, and then finally resorting to firing people, reducing long-term investments. When these things happen, markets will definitely sell off. We still haven't seen the full effect come and go, so we need that cycle to unfold for Bitcoin to be on a strong path to recovery. However, again, you have to be also careful. Bitcoin is likely going to do a lot better than US, like NASDAQ, and it will probably also recover much faster. So all of this analysis basically tells me that the potential for an extreme up or extreme down is now pretty much off table. So we're looking at a period of boring and maybe choppy price action. Probably we have to be patient for 1 or 2 more months until we have a lot more fuel behind the rally. What would you say, Wizard? How would you summarize your thoughts?
I think President Trump said today that it's Biden's fault, so we have to get past whose fault it is. But if I want to put it simply, I was saying that short-term holders are in charge in terms of like they have to see the demand is coming back. If they don't, we have still a lot of top buyers that they are huddling, and I'm afraid they start to lose confidence, start to sell. So if we don't see a positive comeback in macro in coming month, I very well expect to see the bear market get the stretch. But that being said, with the behavior we see from ETFs and the spot market, we have a lot of patient buyers when we break it below 80,000. So I'm not expecting crazy minus 90% from all-time high type of bear market, but I do expect timely bear market. So going sideways long term. And if we break below 71,000, which is one standard deviation below the cost basis of short-term holder, that is where statistically been proven a golden time to start to buy or lump sum your position into Bitcoin. I'm not giving a signal, but I try to be a little bit precise, or I don't want to give a vague number. 71, 72, below that is an extremely positive, extreme pain in the market, and they're going to be high probability that is the range that market bottom is going to be in. But do we get there? I have no clue. If we don't get a positive comeback in macro in coming weeks, we might as well get to 70 or below 70.
So we will be there to look at the data and see what happens and how things unfold, and what happens to these multiple forces that are at play. Yeah. If you want to look at our work again, you can find it here every week. We are going to put out one report summarizing all of our research throughout the week and trying to get to you the gist of what's going to happen. I think a couple of distinctions that we have is that we are covering both important sides for Bitcoin, which is internals of it through on-chain and externals of it through macro. The other one is we are trying to be a little bit bold, and rather than describing the past, we are also trying to give some hints about future. So hopefully you find it helpful. We're getting a lot of kind comments on the articles. Keep that coming. And we will see you in the next video next week. Thank you very much, Wizard.
See you, everyone. Bye.